The truth about personal finance, what the Bible and historic academic research say is the best path to God-honoring financial independence. This will be our 12th lesson in a series of 19. Our guiding verses for this lesson are from Job 22:21. Submit to God and be at peace with him. In this way, prosperity will come to you. And from Hebrews 11:1, faith is being sure of what you hope for and certain of what you do not see. And from Deuteronomy 8:17 through 18, you may say to yourself, my power and the strength of my hands have produced this wealth for me. But remember the Lord your God, for it is he who gives you the ability to produce wealth. And finally, from Job 21:16, but their prosperity is not in their own hands. I'm Ron Fisher, and I'll be giving today's study. Our study today encompasses behavioral finance. From Exodus 18:20, we read, teach them his decrees and instructions, and show them the way they are to live and how they are to behave. And from Jeremiah 18:11, reform your ways and actions. What is behavioral finance? Behavioral finance is the study of what makes some individuals successful investors while others tend to fail. It is the mirror we need to use to self-reflect on our personal strengths, weaknesses, and bias when it comes to money and investing. Charles D. Ellis says, the biggest risk in investing is almost always the short-term behavior of the investor. That's why know thyself is the cardinal rule for all investors. The hardest work in investing is not intellectual, it's emotional. There are two major categories of risk in investing. One is investment risk. The other is investor risk. The first gets all the attention, but the second should be our focus, because while we can do very little about investment risk, every investor can make a major difference with a moderate effort on investor risk. The most important thing. Howard Marks, in The Most Important Thing, Uncommon Sense for the Thoughtful Investor, writes, the discipline that is most important in investing is not accounting or economics, but psychology. Psychological factors that weigh on other investors' minds and influence their actions will weigh on yours as well. These forces tend to cause people to do the opposite of what a superior investor must do. Charles Ellis writes, behavioral economists have shown that as human beings, we are not always rational and we do not always act in our own best interests. Self-inflicted harm applies to all investors because we ourselves cause risks that are quite unnecessary and could easily be avoided if we would just recognize our unfortunate proclivities and discipline ourselves to do less harm, particularly to ourselves and our investments. Benign neglect can be good for us as investors. Our internal demons are pride, fear, greed, exuberance, and anxiety. The best way to start learning how to be a successful investor is to follow the standard instruction of know thyself. When it comes to understanding our financial bias, the words of Paul in Romans ring true. As we read in Romans 7:15, I do not understand what I do, for what I want to do, I do not do, but what I hate, I do. Charles D. Ellis writes, psychologists who study anxiety and fear have found that 4 characteristics make people more worried about their perceived riskiness of a situation than the realities would warrant. These are large-scale consequences, a lack of personal control or influence, unfamiliarity, and sudden occurrence. It is no wonder people who don't expect market downturns sell on the way down or at the bottom. You must be able to continue to invest while the market is down to achieve successful results in stock or stock mutual fund investing. Continued dollar cost averaging is the smartest path through a down market. Jason Zweig says, the secret to your financial success is inside yourself, your trust in God. By developing your discipline and courage, you can refuse to let other people's mood swings govern your financial destiny. In the end, how your investments behave is much less important than how you behave. In the words of Benjamin Graham, indeed, the investor's chief problem, and even his worst enemy, is likely to be himself. There are 3 powerful questions we are trying to answer. 1, how can you minimize the odds of suffering irreversible losses? 2, how can you maximize the chances of achieving sustainable gains? And 3, how can you control self-defeating behavior that keeps most investors from reaching their full potential? Unconscious bias. Unconscious bias refers to the biases or shortcuts our brains make that we are unaware of and which happen outside our control. These snap judgments don't just kick in the moment you're in danger or need to act with an urgency. They are always present, leading us to draw conclusions based on partial or incomplete information. No matter what we actually believe or think consciously, these little unconscious biases can cause financial harm. Once you have a handle on how your unconscious biases manifest themselves, you'll be ready to start managing the impact your biases have on your decisions. At their core, biases are simply mental shortcuts. They are a tool with which we categorize the familiar and unfamiliar, the safe and the dangerous, and anything else we impulsively react to. A little interrogation will help you reframe the norms you observe and reduce their effect on your unconscious bias. We're all built with blind spots. The work of our best investing selves is to be aware of those blind spots and the impact they have on our investing lives. Working on your biases can be a lifetime pursuit. Examining your unconscious bias is the first step in transforming your behaviors and decisions. We will explore some of the most commonly identified financial biases so that you, the investor, can reflect upon them and discipline yourself to recognize when you're using one or more of them in your investment decision-making. Our first common financial bias is home bias. Home bias is when you favor your own employer stock shares in our 401k, local companies, well-known blue-chip stocks, or companies whose product we use, or simply the habit of investing in what is already familiar. It is investing in the U.S. stock market, which only represents half of investable companies worldwide, while not investing in international stocks small cap stocks, or REITs. Recency bias. Jonathan Clements writes, recency bias is when we assume that the current market direction will continue to be the sustained market direction, when in reality the market can reverse course at any time, or the assumption that the immediate past is predictive of the long-term future. While the long-term course of the stock market has been up, expect market declines and recognize volatility as a normal course for the stock market. William J. Bernstein writes regarding recency bias, what makes recency bias such a killer is the fact that the asset classes have a slight tendency to mean revert over periods longer than 3 years. Mean reversion means that periods of relatively good performance tend to be followed by periods of relatively poor performance. Reverse also occurs. Periods of relatively poor performance tend to be followed by periods of relatively good performance. Howard Marks makes a very important point when he writes, there is little I am certain of, but these things are true. Cycles always prevail eventually. Nothing goes in one direction forever. And there is little that is as dangerous for the investor's health or wealth as insistence on extrapolating today's events into the future. Hindsight bias. Hindsight bias makes the market seem more predictable than it really is, causing us to pursue our current investment hunches. The winner and loser stocks or stock mutual funds are only identifiable in hindsight. Status quo bias. Status quo bias is the ease of making no changes. Overconfidence. Jonathan Clements writes, overconfidence makes us think we are more knowledgeable or better investors than we really are. Tends to make us more short-term speculators, usually resulting in more trading in stocks and higher stock allocations. Men tend to trade more and pursue riskier stock investments strategies than women, making women many times the better investors. Ben Carlson writes, increased trading activity from overconfidence can lead to another 1.5 to 6.5% in relative losses. Overconfidence is one of the biggest destroyers of wealth on the planet. It leads people to believe that they don't need to practice risk management. One of the most important theories to understand in the portfolio management process is Benjamin Graham's concept of margin of safety. It provides a cushion for the inability to predict the future. William Bernstein writes in regards to overconfidence, there are really two behavioral errors operating in the overconfidence playground. The first is the compartmentalization of success and failure. We tend to remember those activities or areas of our portfolios in which we succeeded and forget about those areas where we did not. The second is that it's far more agreeable to ascribe success to skill rather than to luck. The Bible speaks of overconfidence in Job 6:20. They are distressed because they had been confident. They arrived there only to be disappointed. And from Romans 12:3 we read, do not think of yourself more highly than you ought, but rather think of yourself with sober judgment in accordance with the faith God has distributed to each of you. Herd behavior. Herd behavior is following what everybody else is investing in due to the widespread publicity of a rising of the stock market. In the words of William J. Bernstein, we read, "This, in turn, produces high stock prices, which results in low returns. The saddest part of this story is that pie-in-the-sky investing is both infectious and emotionally effortless. Everyone is doing it. Human beings are quintessentially social creatures. In most of our endeavors, this serves us well, but in the investment arena, our social instincts are poison." Burton Malkiel and Charles Ellis write, "Any investment that has become a topic of widespread conversation is likely to be especially hazardous to your wealth. Following the herd, believing this time is different, has led people to make some of the worst investment mistakes." We read from Isaiah 53:6, "We all, like sheep, have gone astray." Loss aversion. People are far more distressed at taking losses than they are overjoyed at realizing gains. Researchers have found that the effect of investment losses is twice as powerful psychologically than investment gains. Risk aversion myopia. Risk aversion myopia is when human beings experience risk in the short term, overemphasis on the possibility of short-term loss, instead of considering their long-term goals when making investment decisions. Risk horizon. Richard Thaler, in a clever bit of research, estimated the risk horizon of the average investor to be 1 year. Myopic indeed. Some bear markets can take up to 4 years to fully recover. Remember, you are buying stocks on sale during a bear market and will realize the benefits of this upon the stock market recovery. Regret avoidance. William Jane Bernstein writes, "Human beings are not very good at taking losses or admitting failure. The most consistent bit of irrational investment behavior is the commonplace observation that we are less likely to sell losers than winners. This is known in behavioral finance as regret avoidance. Holding onto a stock or stock funds that has done poorly keeps alive the possibility that we will not have to confront the finality of our failure." Representativeness. William Jane Bernstein writes, "Most small investors naturally assume that good companies are good stocks, when the opposite is usually true. Psychologists refer to this sort of logical error as representativeness." Mental accounting. William J. Bernstein writes, "Mental accounting refers to our tendency to compartmentalize our successful and unsuccessful investments, mentally separating our winners and losers. This is particularly dangerous because it distracts us from what we should be our main focus, the whole portfolio returns." Endowment effect. Ben Carlson writes, "The endowment effect causes investors to overvalue investments that they already own." Confirmation bias. Ben Carlson writes, "Confirmation bias draws us into only those sources that agree with our current mindset instead of looking for opposing viewpoints." Availability bias. Ben Carlson writes, "An availability bias means that whatever information is in front of us right now is what we'll base our decisions on, simply because it's there. Capitulation. Howard Marks describes capitulation as when investors hold to their convictions as long as they can, but when the economic and psychological pressures, usually late in the market rising cycles, become irresistible, they surrender and jump on the bandwagon. The tendency towards self-doubt combines with news of other people's successes to form a powerful force that makes investors do the wrong thing, and it gains additional strength as these trends, the market going up, goes on longer. It's one more influence that must be fought. Conclusion. Ben Carlson writes, fear, greed, euphoria, panic, speculation, envy, these are the killers of your portfolio. It doesn't matter how great an investment strategy one has, if they are unable to drum up the requisite discipline to follow it over various market cycles. Those who are able to calmly stay the course and follow their process when everyone else around them is losing their heads will be the investors that succeed at the expense of others. Discipline is the ultimate decider between the winners and the loser in the financial markets. The most important lessons have nothing to do with specific investments and everything to do with making good decisions and developing the correct temperament. One of the biggest mistakes investors make is letting their emotions get in the way of making intelligent investment decisions. Behavioral finance is the mirror we need to use to self-reflect on our strengths, weaknesses, and biases when it comes to money and investing. Charles D. Ellis writes, 4 characteristics make people more worried about the perceived riskiness of a situation than the realities would warrant. 1, large-scale consequences. 2, a lack of personal control or influence. 3, unfamiliarity. And 4, sudden occurrence. While Benjamin Graham writes, indeed, the investor's chief problem and even his worst enemy is likely to be himself. The goal of this lesson is to teach the investor to control self-defeating behavior that keeps most investors from reaching their full potential. Action steps. As you read through the list of behavioral biases, did any of them bring back memories of investment mistakes in your past? Focus on understanding these biases and make a plan of catching yourself before acting on your biased tendencies. 2, after reviewing the list of behavioral biases, do you believe you have set yourself up for financial success through a consistent and disciplined investment plan? Review the rules of your investment plan to make sure that you set yourself up for investing success during extreme market conditions.